In 1602, a Dutch merchant helped create the most powerful trading company in history. Within 7 years, he was secretly trying to destroy it, not out of revenge, out of profit. His name was Isaac Le Maire, and what he invented wasn't just a financial technique. It was a philosophical revolution. For the first time in history, someone discovered you could make a fortune by betting that success would fail. The company he targeted was a VOC, the Dutch East India Company, a commercial empire that controlled the spice trade, commanded private armies, and minted its own currency. It was too big to fail, which made it the perfect target. Le Maire assembled a secret syndicate, spread coordinated rumors of disaster, and executed the world's first organized short-selling campaign. The VOC's stock price collapsed. Investors panicked. And Le Maire made a fortune betting against the company he'd helped build. When the VOC discovered what he'd done, they didn't just fight back. They got the Dutch government to ban his technique entirely. But it was too late. Le Maire had opened a door that could never be closed. He'd proven that markets could be weaponized, that you could profit from collapse, and that betting against success could be more lucrative than betting for it. This is the story of the man who invented short selling and the market manipulation playbook, still used today. Before Isaac Le Maire, markets were simple. You bought something hoping it would rise in value. You sold when you thought it had peaked. Investment was fundamentally optimistic. You bet on success. Le Maire inverted that logic entirely. He realized that if you could borrow shares, sell them immediately, wait for the price to drop, then buy them back cheaper and return them, you could profit from decline. It was elegant. It was ruthless. And it required something most merchants lacked: the willingness to actively work against success. If you're seeing how one man created the most controversial tool in modern finance, hit that like button. And if you want to follow the complete story of how financial weapons were forged, help us reach 1,000 subscribers. We're uncovering the dark origins of systems that still shake markets today. Born in Antwerp in 1558 into a wealthy merchant family, Le Maire grew up in the world of European trade. By his 20s, he'd moved to Amsterdam and become one of the city's most successful merchants, dealing in grain, spices, and increasingly shares in trading ventures. When the Dutch decided to consolidate their competing East Indies trading companies into one massive entity in 1602, Le Maire was there. He invested heavily. He helped structure the venture. He became one of the largest shareholders in what will become the VOC, the first true multinational corporation, and the first company to issue publicly traded stock. Drop a comment telling us where you're watching from and what time it is there. Le Maire's invention of short selling now operates in every stock market on Earth, including yours. Let's explore how a merchant's grudge created the most powerful and dangerous tool in modern finance. The Dutch East India Company, known by its Dutch acronym VOC, Verenigde Oost-Indische Compagnie, was something the world had never seen before. It wasn't just a trading company. It was a state within a state. The Dutch government granted it a monopoly on all Asian trade, the right to negotiate treaties, wage war, establish colonies, and mint currency. It could build forts, maintain armies, and execute justice in the territories it controlled. And crucially, it financed all of this through a revolutionary mechanism: publicly traded shares. Before the VOC, if you wanted to fund a trading voyage, you assembled investors for that specific trip. The ship sailed, returned, hopefully, sold its cargo, and profits were distributed. Then the venture dissolved. The VOC changed everything. It was a permanent corporation. You didn't invest in a voyage. You invested in the company itself. You bought shares that could be held indefinitely, traded freely, and theoretically would grow in value as the company expanded. This created something unprecedented, a secondary market where shares change hands based, not just on the company's actual performance, but on investor sentiment, rumors, and speculation. Isaac Le Maire understood this market's potential immediately. He became one of the VOC's largest shareholders and served on its governing board. His ships sailed under VOC flags. His warehouses stored VOC spices. His wealth was intimately tied to VOC success. But Le Maire had a problem. He was ambitious, aggressive, and increasingly at odds with the other directors, particularly with a powerful merchant named Johann van Oel den Barneveld, who had government connections Le Maire lacked. By 1605, the conflicts became irreconcilable. The other directors, tired of Le Maire's challenges to their authority, forced him out of leadership entirely. For most men, this would have meant accepting defeat, selling shares, moving on. But Le Maire was not most men. He looked at the VOC, the company he'd helped build, the company that had just humiliated him, and he saw something no one had seen before: vulnerability through success. The VOC had become so large, so dominant, that its share price had climbed to levels that assumed perpetual growth. Every Dutch merchant with capital owned VOC shares. The stock had become a symbol of Dutch commercial supremacy, which meant any threat to that perception would trigger panic. Le Maire realized he didn't need to actually destroy the VOC. He just needed to make investors believe it might fail. If he could drive the share price down through coordinated pressure, he could profit from the decline, even while the company itself remained fundamentally sound. But this required a technique that didn't officially exist yet, a way to profit from falling prices. He would have to invent it. And so, in 1609, Isaac Le Maire began assembling what would become the world's first organized short-selling syndicate, not to invest in the future, but to bet against it. Short-selling at its core is simple, but in 1609, it was radical. Here's how Le Maire structured it. First, he identified wealthy merchants willing to join his conspiracy. 9 men total, each with substantial capital and grievances against the VOC. Then he had them borrow VOC shares from investors who held them long-term, nobles, widows, institutions that weren't actively trading. These lenders received a small fee for lending their shares, not understanding what would happen next. Once Le Maire's syndicate had borrowed the shares, they immediately sold them on the Amsterdam exchange at current market prices, which were high, reflecting VOC dominance. This accomplished 2 things. It flooded the market with shares, creating selling pressure, and it gave the syndicate cash from selling shares they didn't actually own. Now came the crucial part. They had to drive the price down before they had to return the borrowed shares. Le Maire launched a coordinated information warfare campaign, the first of its kind in financial history. His agents spread rumors throughout Amsterdam's merchant districts. VOC ships had been lost to storms in the Indian Ocean. War with Portugal had cut off key trade routes. Spice harvests in the Moluccas had failed. The English were undercutting VOC prices. Some of these rumors had kernels of truth. Trade was always uncertain. Ships were always at risk. But Le Maire amplified, distorted, and coordinated the timing to create maximum psychological impact. The rumors worked. VOC shares began to fall. Small investors, worried about losses, started selling, which pushed prices lower, which triggered more selling. As the price dropped, Le Maire's syndicate bought back shares at the reduced price, returned them to the original lenders, and pocketed the difference. It was brilliant. It was ruthless. And it was completely legal. because no one had thought to make it illegal yet. Within months, Le Maire had made a fortune, not by building anything, not by trading actual goods, but by manipulating perception and profiting from fear. But there was a problem. The VOC wasn't actually failing. Despite the rumors, despite the falling share price, the company's ships kept returning loaded with spices. Its forts remained secure. Its profits stayed strong. The disconnect between the company's real performance and its share price became obvious. And when the VOC's directors investigated why their stock was being systematically attacked, they discovered Le Maire's scheme. They were furious, not just because he'd damaged the share price, but because he'd proven that markets could be manipulated, that share prices could be divorced from reality through coordinated deception. The VOC had the resources to fight back, and they did. The VOC struck back with the only weapon stronger than Le Maire's rumors: actual performance and political pressure. First, they published detailed accounts of their fleets, their profits, their assets. They made their financial position transparent to counter the uncertainty Le Maire had weaponized. This stabilized sentiment somewhat, but it didn't stop the short selling. So the VOC escalated. They went to the States General, the Dutch governing body, and argued that short selling wasn't just an attack on one company. It was an attack on Dutch commercial power itself. Remember, the VOC wasn't merely a private enterprise. It was an instrument of state policy. Its success was Netherlands' success. Its wealth-funded Dutch wars against Spain. Its trade monopoly was a strategic national asset. By attacking the VOC, Le Maire was attacking the Dutch Republic itself. The argument worked. In 1610, the States General passed a law specifically targeting Le Maire's technique. The law banned selling shares one does not possess, the first legal prohibition of short selling in history. It imposed fines on violators. It voided contracts for short sales. It made Le Maire's strategy illegal. But here's the crucial detail. The law came too late. Le Maire had already executed his main campaign. He'd already proven the concept worked. And he'd already trained 9 other merchants in the technique. Le Maire himself was investigated, fined, and publicly humiliated. His reputation suffered. His political influence evaporated, but his wealth remained, because he'd successfully completed his short positions before the law took effect. The profits from betting against the VOC had already been banked. And more importantly, the idea had escaped containment. Other merchants had watched Le Maire's campaign. They'd seen it work. They'd understood the mechanism. And they realized that even with the ban, there were ways around it, using options, forward contracts, offshore arrangements. The VOC had won the legal battle. They'd gotten short selling banned. They damaged Le Maire's reputation, but they'd lost a larger war. Because once investors understood that markets could move based on perception rather than reality, once they recognized that coordinated action could manipulate prices, once they'd seen someone profit from decline, the nature of markets had permanently changed. Isaac Le Maire had opened a door, and the Dutch government's law was like trying to close a door after everyone had already seen what was on the other side. The technique would be banned, unbanned, rebanned, repeatedly over the next 4 centuries. But it never disappeared, because the logic was too compelling, and the profits too enormous. Le Maire spent his remaining years bitter and diminished. His son, Jacob Le Maire, attempted to restore the family reputation by mounting an expedition to find a new route to the Pacific, circumnavigating South America through what's now called the Le Maire Strait. But Isaac himself never regained his position in Dutch commerce. He died in 1624, officially disgraced, his technique officially illegal. Yet within decades, short selling had returned because markets couldn't function without it. Here's what the VOC and the Dutch government eventually realized. Short selling, for all its dangers, served a legitimate purpose. It provided liquidity, someone willing to sell when everyone wanted to buy. It corrected overvaluations. If a stock's price exceeded rational value, shorts would bring it down. It revealed fraud. Companies built on lies couldn't withstand short seller scrutiny. In other words, Le Maire's weapon, when used properly, made markets more efficient. The problem wasn't short selling itself. It was coordinated manipulation, using short positions combined with false information to profit from artificially created panic. By the mid-1600s, short selling was quietly tolerated again in Amsterdam, though never officially legalized. By the 1700s, it was common practice in London and Paris. By the 1900s, it was a standard tool in every major market. But the manipulative tactics Le Maire pioneered, spreading false rumors, coordinating attacks, using shorts to destroy competitors, those remain controversial and periodically illegal. Every financial crisis brought calls to ban short selling. Every market panic saw shorts blamed for amplifying decline. And every time, regulators struggled with the same question. Was the problem the tool or how it was used? The answer, uncomfortable as it is both. Short selling can identify overvalued assets and puncture bubbles before they cause systemic damage. But it can also be weaponized to destroy solvent companies through manufactured panic. Le Maire demonstrated both possibilities in his campaign against the VOC. The company was genuinely overvalued based on speculation rather than fundamentals. His shorts helped correct that. But his false rumors and coordinated manipulation went beyond market correction into market destruction. Today, short selling is legal in most markets, but heavily regulated. You must disclose large short positions. You cannot spread false information to influence prices. You cannot coordinate with others to manipulate markets. These regulations exist because of Isaac Le Maire. Every rule about short selling traces back to his 1609 campaign, either allowing what he did right or prohibiting what he did wrong. He was the template for better and worse. Isaac Le Maire invented something that had never existed before, the possibility of profiting from failure. Before him, commerce was fundamentally constructive. You built things, traded things, created value. Even speculation was optimistic. You bet that ships would return, that harvest would be good, that trade would flourish. Le Maire proved you could profit from the opposite, from ships sinking, from harvest failing, from trade collapsing. This wasn't just a financial innovation. It was a philosophical one. It meant that in any situation, someone could benefit from disaster, that every crisis created winners alongside losers, that betting against success could be rational, even optimal. This insight changed how markets work, but it also changed how people think about risk, failure, and incentives. Consider, if you can profit from a company failing, do you have incentive to help it fail? If you bet against success, do you want success to happen? Le Maire faced this question directly. He'd helped build the VOC. Then he bet against it. Did he want it to actually fail? Or just for people to believe it might fail? The answer is, it didn't matter. The profit came from the perception, not the reality, which meant his incentives were aligned with spreading fear, regardless of truth. This is why short selling remains controversial. Not because it's inherently wrong, but because it creates incentives that run counter to the stated purpose of markets, efficiently allocating capital to productive enterprises. When you can make more money, betting a company will fail than helping it succeed, something fundamental shifts in how capitalism operates. Le Maire was the first to navigate that shift, and everyone since has been following the map he drew. Every major market crisis of the last 400 years has involved short selling. Sometimes shorts identified real problems, like in the 2008 financial crisis, when short sellers spotted the housing bubble before regulators did. Sometimes shorts amplified panic, like in the 1929 crash, when coordinated shorting turned a correction into a catastrophe. The technique Le Maire invented is now so embedded in markets that we can't imagine finance without it. Options, derivatives, hedge funds, arbitrage, all depend on the ability to bet against assets rising in value. Le Maire opened the door, and finance walked through and never looked back. If Cosimo de' Medici taught the world that debt could be weaponized for power, and John Law showed that money could be created from belief, Isaac Le Maire revealed something darker, that destruction itself could be profitable, that you could tear things down and get rich doing it, that failure could be more lucrative than success, that betting against the world could make more sense than betting for it. He invented a tool, a powerful tool, a dangerous tool, and we're still trying to figure out whether it's made markets more efficient or simply more ruthless. Isaac Le Maire helped build the greatest trading company in history. Then he tried to destroy it, not from revenge, from profit. He invented short selling, the ability to bet against success, and win. He proved markets could be manipulated through coordinated deception. He showed that failure could be more profitable than success. The Dutch banned his technique, but it never disappeared. It evolved, spread, became fundamental to how modern markets operate. Every financial crisis since has involved the tool Le Maire created. Every market manipulation playbook uses tactics he pioneered. Every short squeeze, every bear raid, every coordinated attack on a company's stock, it all traces back to 1609, to Amsterdam, to one merchant's ruthless innovation. If you're starting to understand why markets crash suddenly and mysteriously, subscribe for the rest of this series. Like this, if you'd never heard of the man who invented short selling, the most controversial tool in modern finance. Comment whether short selling makes markets more efficient or just more dangerous. The answer shapes everything. Share this with someone who trades stocks without knowing the dark origins of the tools they use. The series continues. The next man we cover took Le Maire's lesson, that perception matters more than reality, and used it to buy emperors. Isaac Le Maire proved that you can profit from collapse, and once that door opened, it never closed.